What's the probability of a recession coming, I mean, anytime soon, even looking into 2020? I know we had discussed this fall. You had a probability. What is that outlook right now for you?
It's around 40% right now. In the summer, around August and early September, things were looking pretty dire. You might remember that there were calls for an emergency intra-meeting 50 basis point rate cut from the Fed because the data was getting soft, and it's gotten a little bit better since then. So when we look at things, the ISM looks bad. Like I said today, that certainly looks recessionary. Consumer sentiment, though, remains at a decent level. What we have to watch for is consumer confidence declining, because that's almost definitional that would cause a recession. And we've seen retail stocks getting substantially weaker recently, and there's a little bit of doom and gloom starting to surface about the holiday season. I'm not sure that's going to prove to be fully justified. But so I think that the sentiment is holding up. The leading indicators are close to zero on a year-over-year basis. You need those to go negative for a recession. So when we put it all together, I think it's about a 40% chance, which is down from where it was during the summer. And the yield curve is no longer inverted. A lot of people think that that is happy news about averting a recession. But the way history works is that the yield curve inverts, and it did earlier this year, and then actually the Fed starts easing because they realize that the inverted yield curve is actually giving us information, and people breathe a sigh of relief, but actually the curve always de-inverts, turns positively slope before the front edge of recession. So when I actually put that in the category of being suggestive of a recession in the next 12 months, not averting a recession in the next 12 months. So you put it all together, it's about a 40%. There's not a lot of information in that forecast that I'm giving you, because that's pretty much the consensus of economic forecasters, which proves once again that I'm not truly a contrarian. Everyone says I'm a contrarian, but I'm not. I just try to think objectively. Sometimes that objective thinking takes us to a conclusion that's different from the consensus. At this point, relative to recession, I'm pretty much in line with consensus economists.
Well, another area that folks like to pay attention to when it comes to your calls, the election. 2020 is starting to shape up. You nailed the Trump presidency, sure, I think, before pretty much anybody.
Before the primaries even started,
exactly.
I said Trump was going to win.
What are you thinking of right now?
It's all about the economy. I think that if the economy holds together, and it just might, into the election, I think Trump's going to win. When you look at the slate of Democratic candidates, it's pretty weak. And you can sort of see that from the polling, that we have a flavor of the month thing kind of going on, where you had Kamala Harris looked good for a while, then Elizabeth Warren looked good for a while, and they've really just tanked in the past few months. And now the flavor of the month is Pete Buttigieg, who I think is just a terrific speaker. When I heard the mayor of South Bend, Indiana, had thrown his hat in the ring for the Democratic nomination, I didn't know who he was. Of course, nobody did. I laughed out loud. Then I saw him speak, and I was incredibly impressed. He's just so well-spoken, so good on his feet. But he sort of looks like he's running for student council. He's so young. So it's very hard for me to believe that he's really going to endure, even though he is very talented. I think he has a great future. I look at the Democratic candidates, I don't see any of them as being winners. I said in May of this year that Joe Biden has no chance. I can't find any winners there. So the only way that Trump doesn't win re-election is a recession, I think. And if there is a recession, I don't even know if he could run, because he runs on braggadocious language. And it's difficult to get braggadocious if you have a negative sign in front of the GDP. However, maybe he's just really diabolically clever after all. And he put on the tariffs to weaken the economy so that the Fed would cut interest rates. We all know monetary policy works with a lag. So the Fed's cut rates 3 times. Maybe that lag will be enough to keep the economy going into the election. He also has the tariffs on, which he can remove. I mean, think about it. If you were thinking of buying patio furniture, this is a real-life example, my own life. I was buying patio furniture, and I got the invoice, and it said $2,000 plus tax, plus shipping, plus 25% tariff, right on the invoice. And that was a real slap in the face kind of moment, because I realized, for me, I don't really care, but a lot of people, I can well imagine them saying, hey, I can wait out another season with my shabby patio furniture because I can get it without the 25% tariff. Well, if you remove the tariffs in, say, I don't know, April, maybe you'll get a boost in patio furniture sales, and that would, and I'm using this metaphorically, obviously, and that could boost consumer spending. And also, the White House, through Larry Kudlow, has stated twice that they're thinking of tax cuts 2.0. And one of them they mentioned a few months ago was a payroll tax cut, which would put supercharged consumer spending in the short term. Payroll tax cuts go directly to the middle class, and they go directly to spending. Then they also talked about dropping the middle class tax rate to 15%. I don't know if that's just a campaign talking point, But if you actually, I don't know if you could pass these tax cuts, given the political environment, but if you could, that would also keep the economy going. So putting it all together, I think right now you have to believe that the baseline is that Donald Trump is going to win re-election if he runs, if the economy holds together.
Well, we were just talking about the Fed earlier, and the Fed really making a U-turn reversal. From an investor's perspective, has that been frustrating? How would you assess Jay Powell's performance? How would you grade him?
I thought when he took over that there was reason for optimism because he wasn't a PhD economist and was kind of out of the PE world and had kind of a pragmatic understanding of how markets work. And he showed that he had his own ideas and a framework and all this in the fourth quarter of last year. Unfortunately, the market just laughed in his face when he came out in December with a framework that the market really wasn't accepting of. He was going to do quantitative tightening, reduce the balance sheet, and the market just said, if you follow this path, we're in a bear market. And he completely turned around, and then he couldn't put back-to-back press conferences together with a consistent message. Every press conference from basically December until about June was a completely different message from the one before, and they were getting increasingly dovish. And then he kind of went all in on dovishness and started to follow the bond market and cut rates. And you'll notice that at this point, he sounds like an NFL football coach after a losing game. They all say the same thing: got to watch the tape, got to play better, not good enough. Now, Jay Powell does the same sort of boilerplate. He just says, data dependent, don't know what we're going to do. We might, he's basically wants to say as little as possible. So at this point, I think the Fed is kind of rudderless and is more shamelessly following the bond market than ever before. So at this point, I'm afraid I have to give Powell a pretty low grade. I think I'd give him a C- because of the fact that he's really kind of lost his way, as it appears. But the Fed's always really followed the bond market. Very rarely it's been the other way around. I think you have to go all the way back to Volcker almost to see a Fed chairman that was really indifferent to the message of the market and was really driving the market instead of being driven by the market. So Powell seems to be leading the way for kind of cheerleading inflation higher, which is probably one of the reasons why bond yields have risen kind of globally in the United States as well by about 45 basis points or so. It's because they make statements that they want inflation to run hot. There was actually an amazing quote that came out today from Lyle Brainerd. She said that the reasons underneath the Fed wanting to let inflation run hot are very complicated, too complicated to explain to the public. That's what she said, which kind of means that there isn't any foundation underneath it, in my view. It just means that they understand, I think, underneath all of this, they understand that the national debt is compounding at an alarming rate. And central banks globally seem to have kind of a tacit policy of wanting inflation to be higher than interest rates, which I kind of understand. If you're tremendously in debt, it's helpful to string out the compounding problem to have interest rates below the inflation rate, because in that way you are slowly debasing the debt. And that seems to be the motivation under this policy. When they say it's too complicated to explain to the public, I think what they're saying is the explanation is not very attractive, and so we don't want to give it. That we have a huge debt problem and we need to debase it, and we're getting closer to that moment. They're saying things like, we need inflation to make up for past below 2% levels. I don't even understand what that means. Who cares if inflation was targeted at 2% over the last 10 years and came in at 1.5%? So what? It was still inflation. It still wasn't the dreaded deflation that they're so concerned about. So what? Why do we need to make up for it? What kind of economic theory says that you need future inflation to make up for past inflation so you hit some arbitrary average? It really doesn't make any sense. I think it's just gobbledygook for the real reason, which is to keep interest rates low, lower than the inflation rate as the goal.